Stop scrolling and look at this number. $1.2 trillion. That is not the US national debt. That is not the GDP of a small country. That is the trade surplus China just posted for the year 2025. For the last 8 years, we have been told a very specific story. We were told that trade wars work. We were told that if the United States slapped enough tariffs on Beijing, if we banned enough chips, and if we rewrote the supply chains, the Chinese economic machine would slow down, surrender, and balance out. Well, ladies and gentlemen, the data for 2025 just dropped this morning, January 14, 2026. And it proves that the exact opposite has happened. Despite the tariffs, despite the sanctions, and despite a massive geopolitical standoff, China isn't just surviving. It is flooding the planet with goods at a rate human history has literally never seen before. But here is the twist that Wall Street isn't pricing in yet, and it's why your 401k might be in the crosshairs. China has stopped trying to sell to us. The United States' share of Chinese exports has collapsed to an 11% historic low. They aren't relying on the American consumer anymore. They have pivoted. And that pivot is creating a new economic iron curtain that splits the world in two, driving a wedge through global supply chains and creating a volatility spike that could make 2008 look like a warm-up. If you own stocks in the S&P 500, if you hold real estate, or if you are sitting on cash thinking the inflation fight is over, you need to understand what happened yesterday. Because the China Shock 2.0 isn't coming. It's here. Let's peel the onion. Let's look at the raw data released by China's General Administration of Customs this Wednesday. The headline number is terrifying for Western policymakers, a trade surplus of $1.2 trillion. To put that into perspective, that surplus alone is larger than the entire GDP of Saudi Arabia. It's bigger than the economy of Switzerland. It is a mountain of cash and credit that Beijing is sitting on, generated by selling the world far, far more than it buys. Now, on the surface, the Make America Great Again protectionist strategy seems to have worked. If you only look at the US-China bilateral trade, it's a bloodbath. In December 2025 alone, Chinese shipments to the US plunged by over 30%. For the full year, they were down 20%. If you are a politician in Washington, you take a victory lap. You say, look. We decoupled. We aren't dependent on them anymore. But here is the economic reality that politics ignores: capital is like water. It flows where resistance is lowest. When President Trump, currently in his second term, ramped up the tariff war, he didn't kill the demand for Chinese manufacturing. He just displaced it. This is what economists call the Hydra Effect. You cut off one head, the American market, and 3 more grow back in the global south. While exports to the US cratered, look at where the goods went instead. Africa, up a staggering 26%. Southeast Asia, up 13%. Europe, up 8%. Latin America, up 7%. This is the fastest growth China has seen in 3 months, totally blowing past Bloomberg forecasts. The experts predicted a 3.1% gain. China delivered 6.6%. Why does this matter to your wallet in Chicago or London? Because the global economy is a closed loop. If China is selling 26% more goods to Africa and Latin America, those regions are becoming economically integrated into a Chinese standard, not a Western one. We are seeing the formation of a parallel economic system. When these emerging markets build their infrastructure, their 5G networks, and their power grids, they are using Chinese hardware paid for with Chinese surplus capital. This means American companies, the Caterpillars, the GMs, the Boeings of the world, are losing market share in the fastest growing regions on Earth. The S&P 500 is priced for global dominance. But if 40% of the world is suddenly buying exclusively from brand China because the US tariff wall forced a relocation of trade flows, those earnings multiples on Wall Street are going to contract hard. But we have to ask the deeper question: why? Why is China pushing exports so aggressively right now? Why risk angering the EU and inviting more sanctions? The answer lies inside China's own borders. And this is where the story gets really dark. China is suffering from a massive imbalance. Historically, a country gets rich by manufacturing, and then eventually, its own citizens start spending money. They buy the cars, the fridges, and the services. The economy transitions from made in China to bought in China. That transition has failed. Or at least, it has stalled significantly. China is currently navigating a brutal property slump that makes the 2008 US housing crash look like a hiccup. Real estate was the primary savings vehicle for the average Chinese family. With prices falling and developers defaulting, the wealth effect has evaporated. Chinese consumers are scared. They aren't spending. When domestic consumption is weak, factories have 2 choices. 1. Shut down and fire everyone. 2. Keep the machines running and dump the product overseas at whatever price moves the inventory. They chose option 2. Bloomberg Economics points out that the US share of China's exports is at an 11% low, but the volume of goods leaving Chinese ports is at a record high. This is a classic case of deflation exporting. Because Chinese demand is low, prices in China are dropping. To keep factories humming, they export those low prices to the rest of the world. Now, you might say, hey, wait a minute. Isn't that good? I want cheaper stuff. In the short term, yes. This flood of goods is one of the reasons why goods inflation in the US and UK has been stubborn but hasn't exploded into hyperinflation recently. We are importing cheap deflation from the East. But here is the trap. If Chinese companies are selling EVs, solar panels, and steel at rock-bottom prices just to keep their lights on, Western companies cannot compete. We are talking about margin compression. Lin Song from ING warned about this explicitly. He noted that while this export boom is encouraging for China's GDP, it is facing massive pushback. Why? Because you can't just export your way out of a property crisis without cannibalizing the industries of your trading partners. This is why Europe is furious. This is why Latin American countries like Brazil and Mexico are starting to raise their own tariff walls. They see a tsunami of underpriced goods coming to wipe out their local manufacturing bases. For the investor, this signals a race to the bottom. Companies in your portfolio that compete with Chinese manufacturing are about to face a pricing war they cannot win. Here is the other critical piece of the puzzle that the mainstream media often misses. 10 years ago, when we talked about a China trade deficit, we were talking about plastic toys, fast fashion, and cheap electronics. Walmart stuff. The 2025 data shows a terrifying transformation. While exports of toys, shoes, and clothing actually contracted, exports of high-value goods surged. Semiconductors, up over 20%. Cars, up over 20%. Ships, up over 20%. Do you see the pattern? China isn't trying to be the world's sweatshop anymore. They are moving up the value chain. They are coming for the industries that Germany, Japan, and the United States consider their crown jewels. Let's take the automotive sector. For decades, Germany and the US owned the global car market. But in 2025, Chinese EV exports exploded. And they aren't just going to Europe, they are dominating Southeast Asia and taking over markets in the Middle East. This is a direct threat to the German economy, which is already teetering on recession. If China captures the global auto market the way they captured the steel market, the DAX is in trouble. And because the global financial system is interconnected, a crash in German manufacturing pulls down American banks and pension funds exposed to Europe. Furthermore, the Chinese government is doubling down on this. The report mentions that authorities are canceling export tax rebates on lower tech items like basic solar components to force the industry to upgrade even faster. They are intentionally killing off their low-end capacity to focus all their resources on dominating high-tech, future-proof industries. This is an economic offensive. And it is happening right as the US is retreating into protectionism. Now, let's bring it back to the immediate danger. The Black Swan event. The report mentions a fragile truce between Beijing and Washington. A ceasefire in the trade war that is held, mostly. But just this week, President Trump announced new tariffs on goods from countries trading with Iran. Here is the connection: China is the world's top buyer of Iranian oil. China buys that oil to fuel the very factories that are pumping out this $1.2 trillion surplus. Trump is threatening to derail the entire one-year truce because of this link. If Trump pulls the trigger on secondary sanctions, punishing Chinese banks or companies for dealing with Iran, the trade war goes from cold to hot very quickly. We are looking at a potential retaliation cycle in 2026 that could include 1. Rare earth embargoes. China controls the processing of the minerals needed for F-35 fighter jets and iPhone batteries. 2. US Treasury dumping. China still holds massive amounts of US debt. If they start selling it off aggressively to defend their currency or spite the US, bond yields spike. When bond yields spike, mortgage rates in the US go up. If the 10-year Treasury hits 5% or 6% because of a trade dispute, the US housing market freezes. See the connection? A tanker of oil moving from Iran to Shanghai can result in your 30-year fixed mortgage becoming unaffordable or your home value dropping. Wang Jun, the deputy head of the Chinese Customs Authority, said it plainly in the briefing: the external environment for China's trade development is still grim and complex. Translation: we know a storm is coming, and we are stockpiling cash to survive it. So, where is this going? We are looking at the landscape of 2026. The bull case for China: if this trend continues, China pivoting to the global south, we will see the solidification of a non-dollar trading bloc. China is already settling trades in yuan with many of these partners. If 40% of global trade moves away from the US dollar because they are trading with China, the demand for the dollar falls. Lower demand for the dollar means higher inflation at home for Americans. It means our government cannot borrow as cheaply. It means the exorbitant privilege of printing money without consequences starts to fade. The bear case for China, the other side of the coin, is that the world simply cannot absorb this much stuff. There is a limit to how many EVs Brazil can buy. There is a limit to how much infrastructure Africa can finance. If the global south becomes saturated and the west closes its doors completely, China's factories hit a brick wall. That leads to a massive inventory glut, factory closures in China, and a financial crisis in Beijing that spills over into global markets. Remember, a crashed Chinese economy is deflationary. It sucks demand out of the world. It kills commodity prices. Oil, copper, and iron ore would crash, destroying the economies of Canada and Australia. The likely scenario, we are heading for fragmentation. The world is splitting into two distinct supply chains. Block A, the US, Canada, UK, and parts of Europe. Block B, China, Russia, Global South, and parts of Asia. As an investor, this is a nightmare to navigate because efficiency is dying. Things will cost more in the West because we are cutting out the cheapest supplier. Profits will be lower. And volatility will be higher. So, what do you do? How do you protect your money in a world where the world's second largest economy is aggressively decoupling from the first? 1. Watch the multinationals. Be very careful with US companies that derive a huge chunk of revenue from China. The era of Apple or Nike just sailing into the Chinese market and making billions is ending. Nationalism and domestic competition in China are eating them alive. Apple's market share in China is already bleeding to Huawei and Xiaomi. If you are heavy on stocks that rely on the Chinese consumer, you are betting on a horse that has already been hobbled. 2. The inflation hedge. If the world fragments, supply chains get less efficient. That is inflationary in the long run. Even though China is exporting deflation now, the tariffs and trade barriers the US is erecting are inflationary taxes. You need assets that handle inflation well. Real assets. Commodities. But be selective. Industrial metals might suffer if China slows down, but energy and strategic minerals are critical for the new independent supply chains we are building. 3. Emerging markets. Look at the beneficiaries. Who wins if China exports to them? Who wins if manufacturing leaves China? Vietnam, Mexico, India. These are the connector economies. They sit between the US and China. Investing in broad emerging market ETFs might be a way to capture the growth of the global south without the political risk of holding Chinese assets directly. For defense and reshoring, the US government is going to spend trillions to rebuild its own industrial base to counter this threat. Stocks in US manufacturing, robotics, and defense contractors are effectively government-backed plays at this point. The $1.2 trillion surplus is a threat the Pentagon takes seriously. The headline is $1.2 trillion. But the story is the end of globalization as we knew it. We are witnessing the divorce of the century. China has realized the marriage with the American consumer is over, and they have already moved on to new partners. While Washington argues about tariffs, Beijing is rewiring the plumbing of global trade. They are building a fortress economy designed to survive without us. The question isn't whether this is fair or unfair. The question is your portfolio built for the world of 2015, or is it ready for the fractured reality of 2026? Because when giants fight, it's the little guys, the retail investors, the pension holders, the savers, who usually get stepped on. Don't get stepped on. Thanks for watching. If you want to know which specific sectors I'm looking at to hedge against this trade war, check the link in the description for my deep dive newsletter. And do me a favor, smash that like button so the algorithm knows you care about your money. I'll see you in the next one.